So what are you expecting from the Fed meeting, and how are you invested going into year-end, December 1st, this week?
Right. So as for the first part of it, as far as Powell, they've indicated in the minutes they're going to slow down. So probably expect a 50 basis points, then a quarter in a quarter. I like to think we're in the 7th or 8th inning of this, and we don't have to go to extra innings, so to speak, because there are some Fed governors that may want to push up the terminal rate well past 5%. For us in the end of the year, we kind of see where we are. Look, value's had a pretty decent year. Those value ETFs are up. It's the growth stocks. It's the growth names that inflation's been biting them. And again, you see the NASDAQ down more than 20% year to date. And I think going forward, the midterm elections are positive. That's a healthy tailwind, obviously. You have the seasonality effect. And of course, some of the other impact. But I guess the problem we really have, and we can throw a wet blanket on this market right now, if you don't mind, Maria, is where we are with earnings. Companies with top potato with higher energy costs are not able to pass them on to consumers. Higher unit costs, labor costs are going there. And if you kind of start playing around with numbers, Maria, you get to the S&P 500 earnings around 200 to 210 maybe next year. That's our estimate. And if you're generous and give it a 20 multiple, there we are. That's S&P 4000. So look, we know, by the way, markets are very elastic. They could trade well above that value number, or well below for that matter. But again, just get a sense here. We've had a huge move since middle of October to us, and the clouds that are forming in China with the weight of the S&P 500 kind of round fair value-ish. We'd be looking to sell into this rally a little bit.
All right, cautious going into year end after a pretty good November. Depending on which average you look at, you're talking about 2.5% to 4% gains for the major indices in the month of November so far. Ken, it's great to catch up with you. Thank you so much.
Great. Thank you.
All right, Ken Mahoney joining us. Quick break. And then